15% of the time we're in recession. And if you say we've got a 15% chance of recession, you're basically saying there's no chance of recession.
Yeah.
Saying it's statistically unlikely that it's going to happen, but at some point it's got to happen.
This podcast is for advisor use only and not to be distributed to the public. The Wealth Consulting Group is an SEC registered investment advisor, and the opinions voiced and contents in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and is no guarantee of future results. All indices are unmanaged and may not be invested into directly. The economic forecasts set forth in this material may not develop as predicted, and there can be no guarantee that strategies promoted will be successful.
Welcome to this episode of The Bull of Wall Street. My name's Talley. I'm the Chief Market Strategist at the Wealth Consulting Group, and I'm joined by my co-hosts Jimmy Lee, our CEO, and Jim Warden, our CIO. And this time, as you can see, our very special guest is none other than the great Chuck Jaffe himself, the host of Moneylife. I love that show. And also a columnist for Market Watch. Welcome to the show, Chuck.
Thanks so much for having me, guys. I appreciate it.
100%. So we wanted to have you on, not just because you're a longtime friend. We just like the word old, so we use the word long time. But you're a veteran podcaster. You've been doing you tell us how long you've been doing Moneylife?
Well, Moneylife started as live radio in Boston, and that was back around 2000. And then it continued until the station wound up. It turned out that the guy who ran the station made his money the old-fashioned way. He stole it from people. So the station went away. Moneylife went away. It then came back in some other forms, but it was launched in its current form, which is as a podcast, April 30th of 2012. So we have been around pretty much every day that the market has been open since then. So we are 5 days a week, 52 weeks a year.
Amazing.
Every day the market's open.
Wow.
It's 3,200, 3,400 shows by now.
Wow. Well, so when Jimmy wanted to do this, and this is his kind of baby, I reached out to you for pretty much everything, for your insight, including the hardware, like this mic. You said, get this mic. And you were using Riverside. That's the industry standard to record the pod. But so what's your cadence again? Is it every day, or do you do multiple sessions a day?
Well, the show is daily, and then there are 3 to 4 interviews or segments within each show exclusive of my intro and my goodbye. So functionally, the show has 5 to 6 parts. 3 to 4 of them are interviews. And then it's 5 days a week. So if we do,
that's intense.
The math's simple. We used to always be 4 interviews a day. If we were 4 interviews a day, that's 20 interviews a week, 52 weeks a year. That's 1,000 guests.
I shouldn't have asked, because it's probably going to give Jimmy some bad ideas. But okay,
No.
So another great reason to have you on, Chuck. It's not just because your insights, you're a veteran podcaster, a longtime friend, but I think you're a great way to take the pulse of consensus, and you talk to so many people, what you're hearing from guests. So eventually we're gonna kick it to Jimmy and Jim in a second, but we want to hear recession, yes or no, are stocks going up from here, and by how much, sectors, what should we be focusing on, style, size, global. But before we get into all that, maybe just tell us and our advisor audience maybe some things that they don't know about you from a personal perspective, like your passion for lacrosse.
I think within the industry, that's become pretty well known. Let's start, since you've got an advisor audience, let's start with where I am on advisors, because there will be some folks who recognize the name and go, oh, him, and they may not like me because, well, I think by now there are like 4 books written on choosing and working with financial advisors, but I wrote 2 of them. Awesome. So that is some folks love those books. Some folks hate those books, whatever. They were written a long time ago. I do believe in choosing advisors the right way. So for an advisor audience, they may know me from there. There's plenty of people in the financial world who have ties to the lacrosse community. I have deep ties to the lacrosse community. I am the owner of the Boston Box Lacrosse League, which currently is looking for a new home since the place we play burned to the ground a couple of weeks ago. But
Sorry to hear.
I'm a veteran observer of the industry. I've done play-by-play at the professional level for the World Championships on both field and box lacrosse, etc. I'm a longtime player, and I still play when my old fat body allows me to. So there are plenty of folks in the financial world who sometimes see me on a lacrosse field or what have you, and there's plenty of stories of guys. I am known at certain industry events to wear a lacrosse tie, not because I want to show my allegiance to the sport, but because I want to show somebody who's a speaker that we've probably shared some air or we've been on the same dirt. And sometimes as a journalist, that helps you get a better question. That gives you a little bit better thing. But so all of those things, play a part in who I am. I would say from the advisor community, I have a different side of things in my world. I have a very odd sideline business, which we didn't think would have much go with the advisory community, but which does. So I have a sideline business called Heirloom Writing Services, and we help people write obituaries. And we actually do this sometimes with financial firms that are looking for ways to connect with their clients and find more ways to make money sticky and make those generational ties last. So when I started the company, I didn't actually think it had any sort of financial planning thing. And yeah, it has plenty of financial planning things. I work with planners and advisors all the time.
Jimmy, jump in here.
Well, I was just going to say earlier, I was researching a minute ago when podcasts started, Chuck, and you said you started in 2012?
Yeah.
So I guess podcasts were earlier than that, but it really didn't get mainstream until like 2014. So, you're like one of the original OGs, right? You're a pioneer.
Jimmy, the way I put it is this, the way we got by initially was based on who I know, right? So on our very first day, because I had done radio shows, our very first day, our very first big interview, that's the segment we've had Talley on the show multiple times for, was with Bill O'Neill, the founder of Investors Business.
Oh, yeah.
And
IBD.
Bill O'Neill agreed to come on my show. And I think on our first day, we got 2 downloads. And I wasn't one of them. I will point out, I did not download our show. I'd already heard it on the first day. Now, that show eventually got thousands of downloads or what have you. But back in those days, nobody knew what it was. In fact, when people talk about download numbers, we don't believe anybody's download numbers in the podcast world, but we really don't believe numbers that we're talking about downloads pre-2016, etc. Because the way they were kept was very different. Like when we started, you didn't go to the podcast players that you guys are on. They basically downloaded from your server. So if somebody was going to Apple for a podcast, Apple was downloading it from your website. So
Wow.
Then it was how good were your servers and all this other sort of stuff. So we have millions of downloads of our show, and we have 7 years that we're kind of like, we had no idea what those numbers are. We don't ever really talk about them, but yeah, we were early, very early.
Were those interviews back then long form interviews? Or what's the format for your show? Meaning, like how long are the guests on typically?
It depends on how you define long. We would say we are long form interviews. And as a guy who just today, 2 hours before I talked to you, was interviewing Bob Dahl, now from Crossmark Global, but formerly, Merrill Lynch,
BlackRock,
BlackRock, the whole works, right?
Yep.
Oppenheimer.
Yeah. Bob's been for all of them. And I always tell the story the first time Bob was on my radio show, and we were doing 14-minute interviews then. And I told Bob, we're long form, and Bob came on in full-on CNBC mode, which is how fast can you answer a question? And we get through 14 minutes, and I had already known Bob for years at that point. And we get off, and we're just about to go to break and cut off, and he goes, so how was that? And I said, Bob, I told you we were not in CNBC mode. Thank God we got to the end of that. And he goes, what do you mean? I said, my next question was probably going to be, what's your favorite color? Like I had nothing left because that's not how we work. And he goes, you want me to talk? And I'm like, yes, please. And he said, invite me back. Of course we did. We will. The next time I had him on, we did a 14-minute interview in which I asked 2 questions. And about a year and a half later at a Morningstar conference, Bob Dahl said, if you really want to hear what I'm thinking, listen to me when I go on Money Life with Chuck Jaffe. So we do our long form interviews are minimum of 12 minutes, usually more 17 to 20, 24. 24 is about as long as we're ever going to get. And our short form interviews are things, they're on surveys or they're very stylized, and they tend to be 8 to 10 minutes at this point. And so
Gotcha.
8 to 10 minutes is a lot of time. Still.
It is. And that's what I've always appreciated about you and coming on the show, because you always let me run. I was actually trying to think. So we've known each other at least 5 years, because that would take us back to Invesco. But I want to say it probably predates that, the Oppenheimer Fund days. So maybe even closer to 10 years, wouldn't you say, Chuck?
If I had to look based on show appearances, you were on my show in 2017 while you were at Oppenheimer.
There you go. Good memory. It still works.
It's not a memory. We have our records of everybody who's ever been on the show.
I meant mine.
It's not a hard search. I don't even need Google for that one. But yes, we do try to make it that we're tight, and no offense to the questions you've just asked me, we tend to not ask people about their background because you're not getting on our show unless you've got chops. Like,
right.
The joke is that when people would say, oh, if you were to write up stories on this, veteran manager does this. I'm like, well, veteran might be great for a headline, but it doesn't work for us because there's no rookies coming on our show.
Right. Okay, so that was the first one. The last one I did with you was 2 to 3 months ago. And man, our bullishness was really being tested, but we stuck to our guns. And I was talking about 6,500, and I've been honest with Jim. I'm afraid that that's actually not bullish enough. He's got a number of 7,000. What are you hearing the most from your guests? Are they super bearish? Are they resisting this rally still? What's going on?
Well, they're far more willing to put numbers on this in the last few weeks. So basically, in that time since you were there, we're getting more and more numbers. And the numbers are consistently 6,600. So you're just a bit shy, with 7,000 being sort of the top end of what we're hearing. And we are falling into that. I could write that story about multiple guests a week right now. So those guests who we have on who will be making that kind of a statement on our show, because not everyone does, and it's not appropriate for everybody. But those who are looking and trying to make that forecast, they're going to be right now 6,600 to 7,000. And then the question is, how long out are they looking? Is that the end of the year, or is that 12 months? Where are they putting the distance? But I have the interesting thing about this market is go back to April and how quickly people that didn't have a recession priced in started pricing one in.
Yes.
And we got well above 50%. And not just the folks who were on my show, like the National Association for Business Economics showed that a majority had suddenly switched to, we're expecting a recession. Mm-hmm. And now I'm not sure that the recession probabilities now are a bit higher than they were at the start of the year. I think they may be lower.
Oh, it's true.
And I want you to think about it this way, and this is actually something that Bob Dahl and I mentioned briefly, which is, if you think that, historically, the U.S. markets are in a bear market or in a declining market 15% of the time, then if you said there's a 15% chance, or we're in recession 15% of the time as well, if we're 15% of the time we're in recession, and if you say we've got a 15% chance of recession, you're basically saying there's no chance of recession.
Yeah.
You're saying it's statistically unlikely that it's going to happen, but at some point it's got to happen.
Well, you're right. But where I was going with that is we haven't changed our numbers. And so we look like wild-eyed optimists. And that was the right call back in, early early April. We haven't changed our numbers, but from a distance, what we saw was a lot of, to your point, Chuck, a lot of strategists, economists chasing the market down and then back up again. One of the first slides in our outlook shows kind of the mirror image of recession odds in the market. And so Polymarket had odds above 60% for recession, and now it's back down to 20%. So, you look like a wobblehead when you're chasing the market in that way. And we just stuck to our guns and looking pretty good here.
I mean, I've got a relevant question for that, Chuck.
Yeah.
As Talley said, and we're doing a little bit self-promoting here, but Jim, our CIO, went out on a limb and said that he thought there was a chance that S&P 500 could get to 7,000 before the year started. In April, when the S&P was under 5,000, 4,800 and change, he stuck to his guns. How many talking heads at that time were still that bullish?
There were a few, but more based on methodology. One of the interesting things, talking to as many people as I do, is, disagree. We say every day on the show, disagreement makes a market. Like, you should never be surprised if somebody is on my show one day saying, I'd buy this stock, and the next day somebody else is on going, sell that stock. And, if all you listen to is ticker recommendations or whatever, it would be horrible, because you basically be selling, to each other. So you always want to find methodology, and it really depends on methodology. If you are looking at shorter term indicators, you're trying to come up with something that is a little bit more short term in terms of your focus, because you want to be a little tighter can we minimize losses, you're going to have to change. If you are looking at a 12-month lens, and you changed in April, I have questions for you. Right? If you changed in April and you've got a 12-month lens, what did you actually see that you thought was going to show up in the technicals? Because there was nothing, events like tariffs or what have you, they move the market, but they are not technical events. There's not, it's market reacting. And let's point out that I can talk all about the talking heads who I get a chance to talk to, who, whether they're right or wrong about what they're doing. But I promise you that individual investors are much more whipsawed and much more, butted about, and are not necessarily getting it right. So you want to take a look at all of this stuff and go, what can I believe in and have the courage of my convictions? And the key thing is, when somebody is changing what they're forecasting, what do you hear in their voice that tells you they are confident? Because if they're not confident, tune them out. Even if it's on my show, tune them out. If you can't hear the confidence, they don't have the courage of their convictions, which is not, you have to stay there through thick and thin. But my hope would be, and Jim, you can answer the question a lot better than I can, was that if it had truly shaken your confidence, at that point, you come back and you go, look, here's what I've seen. And as long as this exists, I can't hold fast to this other thing. I may still think it's going to happen, but this thing out here tells me I need to put on airbags, check the brakes, do whatever. That's the thing that I think is important. Now, again, you have true courage of your convictions. You go, yeah, I see what's happening, but nothing has happened to make me change the reasons why I made the forecast.
Super interesting. So I love just kind of how you're walking through that. If I could ask a follow-up on, because you got a lot of guests on, and William O'Neill, wow, I would have loved to have interviewed William O'Neill. I mean, he's an absolute legend. But going back in time, all the people that you've talked to, I don't know, probably more than 1,000 people or 2,000. I don't know what the number is, but like where, what are the most wild interviews you've had, and what are the ones that you've just really said, hey, that makes a ton of sense? And I guess one of my questions, because I'm super analytical when it comes to things like this, is can you gauge kind of like where people are thinking based on those interviews, especially, looking at the last month, the last 6 months, And then you may have a guest that comes out of left field that's like way out there. But curious, what your thinking is on that.
One thing that's important, we are completely agnostic to the approach of the guest. We say all the time, there is no one right way. There is what way works for you.
Yeah.
And that is hugely important just from the standpoint, as you guys all know, if you're going to be talking to somebody about investing and they say, oh, well, this is a great idea for a balanced portfolio, but that one thing makes me crazy. I won't sleep at night knowing it's great. We can change the portfolio. We can do whatever we need to do to make it work for you. And once we do that, we're not following it. I mean, if you look at the interviews that we've done, and it's, again, when you're talking about somewhere north of 12,000 interviews on this iteration of the show, and then previous iterations of the show, and when we did live radio. And obviously, I had a very special relationship with Jack Bogle. My Bogle interviews stand out for the 13th anniversary of the show in April.
Wow.
We felt we were celebrating the show's bar mitzvah. So I made a little bar mitzvah speech, and we brought back some Bogle clips, and my audience loved that. But it had, and it's not that things like the O'Neill interview didn't stand the test of time, because we did some stuff with that too. It's that it was a little more topical, and Jack was a little more not topical.
Yeah.
But I mean, if you're going memorable, the memorable ones are the other ones. Don't get me wrong. As much as I love talking to Jack Bogle, if I never talk with Robert Kiyosaki again, I won't mind, but it doesn't make terrible radio to have a guy out there who is literally spouting what amounts to nonsense for the average person who is listening. And my audience, and I want to make this clear because, of course, your audience is mostly advisors, I think. Mm-hmm. My audience, I try not to they took offense at the fact that I said, if you're listening to an hour of personal finance talk every day, you are a bloodthirsty shut-in who's desperately in need of a life. That was my take on it. That actually describes me. I am a bloodthirsty shut-in desperately in need of a life. Yeah. But so I didn't think like I identified with it. My audience took some offense at that. So let me tell you what my audience really is. They are above average investors who don't recognize that they are above average. The reason I say that is this. They come to us as average investors. We are the show you graduate to, not your audience because they're advisors. But if you listen to my friend Joe Saul Sehi, who does Stacking Benjamins, or you listen to Paula Pant, who does Afford Anything, another friend of mine, or whatever, and you get your financial life together, and now you want more, we're the show you come to because we're presenting you all sorts of things without really any of the commercialism, it's got to be this way or what have you. So you're interested, we're the show you graduate to. So they come to us as average investors. But you can't listen to our show for 3 weeks. An hour a day of super smart financial talk, and you do it for 3 weeks, you're an above average investor. But not one of them acts like they're like, I'll talk to members of my audience on a regular basis, and it's like, you realize that like when you started talking to me, you had $1 million portfolio, and that was 12 years ago, and now you've got a $3.5 million portfolio, and you're still thinking the same things. Like you're a decade older, you're significantly wealthier, but you still are like, yeah, but when I fly, I know I've got a hip problem and my wife's got knee problems, but it's only 2 hours. So why am I spending money on first class tickets? Yep, you're still average. Realize you're above that. So I think that's a big part of the audience. What that means is that the interviews that get us out there and put the audience outside of its comfort zones. So it's guys like Robert Kiyosaki. It's Harry Dent, famous. He's not really a perma bear. He just has been bearish so long.
Jim brought him up last week when we were talking.
I haven't had Harry on the show in a while. My audience kind of hates it when I do. Like I get my nastiest emails or what have you, and yet it's worth it to understand what the folks at the extremes are. And the funny side is that you'll take somebody else who's a perma bear like Lacey Hunt. If you know who Lacey Hunt is, I'm sure your audience does. And he can be a perma bear, and the audience doesn't necessarily take it that way because he hasn't gotten as much publicity as a Harry Dent. So I think you've got those things. And I think, if you want to talk arguably the most memorable interview of all, although there's a follow-up to it, was in 2002, 2003. I guess it was 3. I had Susie Orman on the show. The original edition of Money Life had a periodic segment called Why I Hate Susie Orman.
Oh, no.
Where we would take clips from her show and kind of show all the things that this is not a good thing, or what have you. So Susie, to her credit, found out about it and decided to come on the show. And in the days when you could break the internet, we broke the internet. Market Watch put a headline, Chuck versus Susie, tune in here. And that was it. We were, et cetera. So I had a tape of that, a cassette tape. That'll tell you it was 2003 that in 2018, we decided to bring back. So I was going to broadcast the World Lacrosse Championships in Israel, needed some time. So we said, let's bring back our most infamous interview. We digitized the tape, hadn't listened to it in about 14, 15 years. And it was way worse than I thought it could have been. Like I had to do an extra segment to just kind of go, do you understand just how bad this is? Because at the time, 2003, the market had gone through the internet bubble. It had crashed, had the bubble burst and you have all the problems. And Susie is out there going, investors are fed up of losing money. So do not be investing in the market. Pay down your mortgage because you don't lose money in real estate. Which was great advice until 2008 came along.
Yeah.
And you were overdone in real estate because she had sunk your boat. And, look, Susie deserves all the credit she can get for helping people, raise them by their bootstraps. You will never hear me say a bad thing about that. And at the same time, if you're going to talk about average investors graduating, well, Susie Orman basically hates stocks. She's pretty much said it. And if you dislike stocks, don't give stock market advice. Just your stock market advice is going to be patently horrible over and over and over again. So if I don't have a problem with somebody who's, if you're permanently bearish, then make your bearish case for why you're bearish now. That's fine.
Yeah.
I'm not looking for you to go, well, here's why I'd be super optimistic. That's okay. If you hate stocks, help people manage their money and say, when it comes to the stock portion of your portfolio, you want to talk to somebody else.
Talk to someone else.
That's an important thing.
Chuck, did you ever talk? Have you ever interviewed? Go ahead, Jimmy.
It's okay.
I was just going to ask Chuck if you ever talked to.
Okay, let's do this with Jim because he's got the direct follow-up on who the
delay.
I promise, Jimmy, we'll get back.
The bulls in the China shop on Wall Street.
So, Chuck, have you ever talked to Jeremy Grantham? Because he's kind of bearish, but he has a lot of reasons for why and food shortages and things like that. I'm just curious.
So the answer to that is yes and no. I have talked to Jeremy Grantham. I've never had him as a guest on the show.
Oh,
he is, sadly, although I have talked to him at conferences and a variety of other things, and earlier in my career interviewed him a few times or what have you, he's pretty much not going to be on any of these shows. I mean, if you can get him, more power to you. We've had plenty of his people on. So his opinion has certainly been registered, et cetera. GMO folks are great. What I'll tell you is that, again, if what we're looking for is courage of conviction, if you read GMO's research and you don't come away thinking they believe what they're saying, you're not reading it carefully enough. Now, you don't have to agree with them. You go, I'm on the same side of the case as you are. But if you're not making yourself a better investor, thinking about that and going, okay, and what am I doing just in case, my optimistic Pollyannish view is not going to turn out to be right, then you've missed something there. So no, Jeremy and I've never had the privilege on the show. I have interviewed him multiple times or been part of interviews with him in multiple times in various places.
What I was going to say is I was looking up Harry Dent. I remember him from the old AIM days. If you guys remember the mutual fund company out of Houston.
Yeah.
Oh yeah.
The Dow was going to go to like some crazy high number, and he was obviously wrong then. But I was looking at an article here from Dividend.com. In terms of the worst market predictions of all time, they've got him down as number 6. In 2013, he said that the Dow is going to crash to 3,000, which which I understand what you're saying, Chuck. And then Kiyosaki, one of my real estate friends here in Las Vegas has a personal relationship with him. And he's been doing like these videos with her. So I see it once in a while. And I don't know what happened with him, but I agree with you. Some people have been so wrong about their predictions, but I'm always someone to say, follow the money. What are they trying to sell? Right. And so, of course, and that's where I want to go with you. When you listen to, obviously having controversial guests that have an extreme market position idea is good for potential listeners and for viewership. But, would you agree that usually when people have that type of view, it's they're trying to sell something? Because I was watching CNBC the other day. There's a gentleman on a major TV commercial that's, got a lot of credibility, but, he's doomsday too. So go ahead, Chuck.
Are they always trying to sell something? Well, I think Robert Kiyosaki is, but I think that Robert, again, things become transparent. And in the case of Robert Kiyosaki, he'll tell you, you're going to see this massive fallout in mutual funds, et cetera. And you say, then what should the average person do? And I say, well, I'm not talking about what someone should do. I don't make it. I just am telling you I wouldn't own those things. Okay, that's not an acceptable answer, right? I criticize Susie Orman for giving stock advice when she doesn't really love stocks, and she'll tell you her personal portfolio heavily skewed towards bonds because that's what she's comfortable doing, and she doesn't need the money she'd get from more stock appreciation. But that doesn't work for the average person. And Kiyosaki literally will say, well, you should never invest in a 401k. And you'll go, but what are you going to do? The average person needs that. They need the match, et cetera. Well, I wouldn't. Okay, that's not an answer. That's not let me come up with something that works for you. That is somebody who basically says, here's what I've got to sell. And that's a man with a hammer. To a man with a hammer, every problem looks like a nail. So whatever you say to Robert Kiyosaki, he's going to bang that nail again and again and again and again. And that's your problem. And it's not that you can't. He could be fabulous when it comes to real estate advice or what have you. But, at this point, he's a guy where there's so many variations on, it's rich dad, poor dad. But then it wasn't really my two dads. It was all that stuff just all kind of rings hollow to me because, your story lacks credibility or again, you're kind of, whatever. But yes, the perma bears, well, frequently the perma bears are selling their newsletters or they're doing whatever. They've got that stuff behind them. Unless, if you want to have a really interesting conversation, and you guys should talk to him. I bet you'd have fun. You don't know Brad Lamensdorf, who is the manager of the Ranger Equity Bear ETF. Now, he's got to be bearish because he runs a bear market fund, but he's not a bear. He is a manager who runs other money. So it's really interesting. Have a conversation with the guy who's got to be bearish about what he's bullish on. That will give you some insight. That's the kind of thing where, again, what are you going to learn from having a discussion with someone? And it's not always what I'm going to learn is what you expect me to do. And by the way, when you have those discussions, Jim, you asked about ones that you remember. We have one other. Every now and again, we get somebody who says, I can't come on the show and talk specific names because, I've got compliance people or what. In all of those interviews, we've only ever had one compliance problem. And it was a guy, I'm not going to name him, who came on the show and when he was asked about a specific stock said, I would back up the truck and put every available dollar I had into that stock. At which point I paused the recording and said, I'm not a lawyer and I haven't stayed recently at a Holiday Inn Express, but my limited knowledge of compliance would suggest that you and some people from the SEC or FINRA are going to become well acquainted if we leave that in. Are you sure that's what you want to say? And the guy said, absolutely. That is the one compliance problem we've ever had. It is one of the most memorable interviews. I wish I remembered what the stock was. He's never been a guest on the show subsequent to that. And so, yes, you do also remember the ones who are outliers. But outliers, he did it from exuberance. I would have been like, that stock, he wasn't wrong. Like that stock did. I remember looking back at it 6 months later, I did not buy it. I Talley, for those who wonder about the difference between journalists and money managers, I'm my own employee at this point. I have the tightest conflict of interest agreement in the entire journalism world, and I don't need to. And so just for those who wonder, I'm not allowed to make any new moves in securities we discuss on my show for 15 trading days after we talk about it.
Right.
Anything I buy for my own portfolio, I got to hold for 6 full months, and I'm not allowed to sell things short. And I have to disclose it if I own it, and it comes up and I am actively involved in the conversation. So in other words, Talley, if you came on and you mentioned a stock like Microsoft and it just goes through, I don't have to stop you to say, hey, I own Microsoft. But if we have a discussion about Microsoft, I have to say, by the way, I own it. So I live by those rules to try to minimize conflicts of interest because it's just better for the folks. And by the way, those 15 trading days, yeah, if I found something that I really wanted to buy, I'd have to wait. It's not 15 trading days after we record it. So it's, we record today, it airs tomorrow or the day after. And trust me, if ever I got called by the SEC, I can promise you what we say about that is what you find in my portfolio.
So if I could just sneak one in here, because you were talking about hammer and nail, backing up the truck. Is there a common market metaphor like that your guests have been using more than others?
No, but the best metaphor I've heard for this year in the market came up on my show in the last week. Now, part of this, the reason that I consider it the best metaphor is that in the early days of my career, before I gravitated towards money markets and personal finance, I covered the aviation industry. I made my bones in the mid 1980s covering airlines, among other things. And Jim Crumpleman, who is the head of equities and the chief investment strategist for Mariner Wealth Advisors, came on my show and he, by the way, had forecast S&P 6,600 when we talked at the end of last year. That was his forecast for this year. He said 6,600 at the high side could get to 7,000. He's still there, never wavered one bit. But his thing is, what we've been going through is, and here's the metaphor, clear air turbulence. Now, if you don't know what clear air turbulence is, clear air turbulence is what happens when there's pretty much a cloudless sky and you're 15,000 or more feet higher, and you hit what is usually known as an air pocket. And your flight drops 1,000 feet in a second or 2 seconds. Okay? You got nothing coming. You can't avoid it because you can't see it. And there are times when it happens with clouds, but not like, oh my goodness, we're flying through a storm. It's like, oh, there's some clouds over there and some clouds over here, and whoosh. Okay? Clear air turbulence is like wind shear, etc. It pushes your plane down. This is white knuckle stuff. But you're not getting off the plane in the middle of it. So that, to me, was the best analogy for what we've had, because he entered the year, as Jim Worden said, he hasn't changed his thing either. Right? Jim, are you hearing this going?
Yeah.
This
100%.
This is a thing. Clear air turbulence. That's the best metaphor for what we've been going through right now that I've heard.
That's a good one. I like it.
Right? And I don't get credit. It's Jim Crumpleman. I'm sorry, Jeff Crumpleman. Jeff Crumpleman is head of equities, chief investment strategist, Mariner Wealth Advisor. He gets the credit.
Nice.
Well, I got a question for Chuck. It's in relation to all the years of doing radio and now doing podcasts, and then the do-it-yourselfer investor. And I know you've written books about how to pick financial advisors and so forth. How do you think about that? As us financial advisors, we've been told for many years about, you're going to have to lower fees, there's going to be margin compression, more technology. Younger investors may not use financial advisors like their baby boomer parents and older parents did. We're not really seeing that happening, though. And what I've experienced is that younger folks, investors, actually want to spend less time doing this on their own. That being said, with the new platforms like Robinhood, there's a lot of people out there that I think look at investing like gambling. I just had a recent experience with a client's son and his friends. But do you think things have changed between the demographics of investors between the older generations and now?
Well, I don't know whether it's the changing demographics or it's the changing technology, right? So when you say you haven't seen it, I think you've been seeing it. I think the rise of robo-investors replaces what was happening. I mean, look, I will point out that when I say that there are advisors who might know me because of my books, they will not like me because one of the things I said about the books is that, for years, financial advisors wanted to compare themselves to doctors. And I wanted to compare them to plumbers and auto mechanics. And they were offended by this. And they shouldn't have been. It's just that they hold themselves to be professionals. I will point out, I'm a journalist. I have all the elements of professionalism, but I don't have to pass an exam. I don't have to do anything else to do what I do. So it's not a profession, okay? To be a financial advisor, there are some exams you have to take, but, we still don't have a legal definition of what a financial planner does. And oh, by the way, when financial planners in the 1980s and 90s were doing some things that got them into trouble, then we had wealth counselors and financial counselors. And how can we repackage what we're doing so that we can stand out some way different? And then we have suitability rules versus fiduciary standard. And you've got, Fisher Investments coming on and saying, we're markedly different. No, they're not. Go do the standards and take a look. The fact is, the vast majority of people who do what they do it as fiduciaries, etc. They're telling you they're different. They're not different. And if they are different, it's in ways that you don't really want to know if you're trying to do best for your money and yourself. So it's not as easy as that stuff sometimes looks like it's going to be. So what's happened is that investors have looked for more ways to get personal stuff. They're now doing it with robo-investing. And they're doing it much more with AI, which is its own set of dangerous parameters that are out there. But what I would tell you is that the average investor never wanted to hire a financial advisor because they didn't want to spend the money when they didn't have the money themselves. So they wanted to wait till they had a certain amount of money and then be able to do something. So what's happened is, in the old days, it was Kiplinger's Personal Finance and Money Magazine and whatever that filled the void. Today, it's Betterment and Wealthfront and whatever, SoFi and whoever else you're going to throw in there that's doing some of that stuff. And then when they get to a certain amount, they go, what I really want is what a financial advisor is truly supposed to give me, which is emotional discipline. The idea that here's where I am, here's where I'm going, and I need to get from here to there and have the temerity and the courage of my convictions to stay on the path. So I need an advisor who's going to get me here to there. One of the things that changed is that in the 1990s, especially as the internet bubble was inflating, well, people don't hire advisors necessarily to say, I need emotional discipline. They hire advisors to go because they're looking at their own portfolio going, I think I could do a little bit better. So they were hiring people saying, well, I need to do a little bit better. I need to do whatever. They were firing them because performance was bad. Well, that's dumb. If what you want is emotional discipline, you should be able to look at this and go, wait, my performance isn't as good as the market? Okay, well, maybe there's a reason. And then what is that? Let's have the discussions with the advisor. I will point out, we've seen all sorts of things that, I mentioned Jack Bogle earlier. I wonder how Jack Bogle would feel about the fact that BlackRock recently introduced two new funds. One is the S&P 500 minus numbers 101 to 500. And the other is the S&P 500 X numbers 0 to 1 to 100. And the idea is, well, you can fine tune and make things more precise. If you talk to the people who started index investing, that's not a thing. That's how do I screw it up? So, we've got plenty of advisors who said, active management doesn't work. I'll become an indexer. But they actively manage indexes. That's not passive management. That's just, I'm not actively active. I'm actively passive. As opposed to, by the way, if you own actively managed funds, but you hold them a long time, then you're passively active, right? There's a lot of different ways that you can do this. We have seen people move away from the classic model. But, by the way, the advisors whose clients are happiest are the ones who give them a good plan. Here's how you get from here to there. Here's why it's happening. We're not ruling out losses, and let us help you understand what the real goals are, and you'll go from there. But yeah, people want to be able to do this quickly, and they think that AI is going to be the salvation. Wait till you get to the middle of that market meltdown. I mean, if you want to question one of the impacts of AI right now, we're back to the emotional things that we were seeing. We still have a huge emotional disconnect. All the soft data is people going, the market sucks, and the market's back at record highs, right? I don't have any faith and I don't have any confidence, but the market took a 20% correction and shook it off in weeks. So, it's the same people who, by the way, I feel terrible about things, but oh, by the way, watch my spending habits, and my spending habits haven't changed. We have that disconnect going on right now in this country. And yeah, I think when you get a significant correction or bear market that stays for a year or two, the answers you're going to get from AI are going to be very unsatisfying.
Can I take us in the direction of the Fed for a minute? Is that okay with you guys? So let's kind of set the backdrop. So the Fed has cut, 3 times? They're projecting 2 cuts this year and 2 more cuts in 26 and 27. So we're talking 7 cuts all in, basically for the easing cycle. And they've been on hold for a while. They haven't done anything for some time. And so that's the big debate now in monetary policy and in economics. And I'm just kind of spitballing here, but if I'm the Fed, I'm just trying to kind of get my arms around why they've been on hold for so long. It's plausible. We've got a nominal GDP growth rate year over year of about 5%. The federal funds rate at the high end is 4.5%. So they're probably sitting there thinking policy's reasonably well calibrated to the nominal pace of activity, and you add in some uncertainty around the effect of the tariffs, which to me comes from a flawed fundamental misunderstanding really of how tariffs work, because they're a tax. But we'll set that aside. What are you hearing, Chuck? What are your thoughts? I know Jim, he's been talking about 2 to 4 cuts this year. Personally, I would worry about what that might mean for the economy. So I'm more of 2 to 4 cuts for the remainder of the cycle.
The other side of that wager, Jim. I will happily take the other side of that wager. No cuts this year.
No cuts.
If I had to wager, 0 cuts this year. And only am I saying that, since we talk about courage of convictions, I've said that since the week after Liberation Day. I am I'm a past president of the Society of American Business Editors and Writers, which is now renamed to Society for Advancing Business Editing and Writing. And although I'm a past president, I'm a current board member. I got myself back on the board. And Jerome Powell gave his first address after Liberation Day at the Cebu conference in Washington, D.C. So I was in the room. And afterwards, I wrote a piece that said, here's what no investor wants to hear right now. Fed's not cutting rates this year. And I understand why folks are thinking about it. And I've had people tell me, you're crazy. The market's pricing whatever. Well, remember, the market priced in 6 last year.
Yeah.
And it didn't get close. Like, to say, it got halfway there. Not really, because it took a lot more than half the year to get there. So the market was way wrong last year. And I think, if anything, all of the pressure and the rest is going to backfire here. Which, by the way, maybe that's actually its intent. Maybe the intent is that if the economy tanks, President Trump can blame Jerome Powell, because truthfully, cutting right now at a time when you don't need it for the economy and you don't need it for the market makes no sense to me. So here's why I don't believe rates are moving. 1, data dependent means we're not going anyplace until there's no choice. And we're not there yet. I mean, the tariff uncertainty, it's clearing up, but it's not done, et cetera. 2, underlying economic numbers are better than any of the panic-stricken talking stuff that you're hearing about. 3, Jerome Powell does not care about how you or President Trump or anybody else feels about this. Not one. He's out of a job next year, though he could stay on the Fed board. That would be unusual, but interesting. Very interesting.
Shadow Fed.
His term goes till 2028 in terms of as a member of the Board of Governors. So he could stay And I wonder whether or not there will be some backroom negotiations about, hey, we're going to keep going. If you wind up shadowing me, which would be a nightmare,
Yeah, I don't think
that would
that's
be the thing
likely.
that could create problems that would make it that we need to have cuts.
Yeah.
But barring something like that, he doesn't care how you feel. He does not care about soft data that shows how miserable the consumers are. He has said repeatedly that inflation of the recent past, the levels that were critical in deciding the election last year, they account for most of the negative sentiment. And he's waiting for more numbers that are hard data. And again, he does not care what the president says. Giving into the White House would be a gut punch to the U.S. Treasury bond market and to the Fed's reputation. I understand why the market expects things, but if you're hankering for a cut, you're going to feel like a long-suffering baseball fan going, wait till next year. I just have a tough time believing it's coming. Again, the numbers could change, and if the numbers do, then he'll do it. But as things stand right now, as we sit here, if you can't tell me what's going to move the numbers, and we haven't seen it in the inflation data, we saw just a little sprinkling of maybe tariffs creeping into the numbers last week, you're going to need a hell of a lot more than that to make him move. So, and each time we get another take on tariffs, the market reaction is more muted. Okay, that plays into do nothing. Wait until there's complete certainty. You don't have to move. The market, the stuff on July 9th when they extended to August 1st, did the market slow down to gawk at that accident, or did they just keep driving at full speed? Because I don't think anybody noticed. And if that's the case and that continues, there's no impetus here. I don't see him cut.
So Chuck, how about the labor market though? I mean, we are seeing softening in the labor market, and I mean, do you think that the Fed just is going to wait until things get really bad? Because that is part of their mandate is full employment.
Well, define what's going to wind up making it really bad, and tell me what the Fed's definition of full employment is, because there are some at the Fed who say what I classically think of, which is full employment is when we're at 4%. There are some at the Fed who say full employment's anything below 5%. Well, if you believe that full employment is anything below 5%, again, not moving.
They're going to wait. They could.
Look, I do believe that in the end, when you get the dual mandates of the Fed, and this was the question. So Powell was there, and it was not a forum where we could have open outcry questions.
Mm-hmm.
So Jim Nelson, the business editor at the Milwaukee Journal Sentinel, who's a friend of mine, who was SABU's president, one of the moderators, said, Chuck, come up with a question. I said, okay, but I'm not smart enough to come up with questions, even though that's all I do every day. I asked 3 different people what they would ask Jerome Powell. Those 3 different people, without naming them, one was the economic head for a Republican president, one was the economic head for a Democratic president, and the third one's got a Nobel Prize in economics. So their questions, which actually were pretty much the same as what I was thinking I would ask, but they did it more gracefully, were basically, when you get to where you have no choice, when you get to the point where the inflation and the jobs data are at pure logarithms, what's going to be the decision? And at that point, I do believe that's when you're going to see rate cuts. But the reason that I believe that is that as much as, the Fed's target is 2%. The question that I've been asking for years has been, if the economy's humming along, why doesn't the Fed just go, we're doing just fine with inflation at 2.5%. We don't have to worry about this so much. This is A-okay. And the Fed will not back off of that number. But the economy's done okay, which means that if the unemployment numbers do get high enough, the Fed will ultimately say, okay, we're going to cut because we have to live. We can live with inflation. We've been living fine with inflation above target. That's ultimately why, when the two things get together, the question that was asked was, immovable object, unstoppable force, right? When those two things get together, that's why rates will be cut then. But they're not getting cut until that's the situation. That's my belief on it. And there was absolutely nothing in Powell's demeanor that suggested otherwise. Nope, not God, not country, not money, not whatever was moving him off of it. So there you go. So you sit in the room and you take a measure of the man, and I get the benefit of being able to do that. It was the right question. It was asked the right way, because you can't ask Powell questions that would get him into some sort of political debate. He literally started talking. There was a point where he started talking about like the 6th paragraph of the Fed's mandate. And you have to go back and like read it and go, oh, if he's going there, he just told you. If it truly comes to loggerheads, he'll cut rates, but only when it truly comes to loggerheads. I think that's 2026.
So this is interesting. I'm glad I asked this question. So between the two of you guys, Chuck and Jim, what do you think this means for the bond market? Is the 10-year kind of stuck in a range here?
You go first, Chuck.
I'm not the expert, but I would say yes. I think you're looking at a range-bound treasury, but I don't think, as much as there are some folks who hate that, the answer is you're clipping a decent coupon right now. I mean, I think the answer of the folks at the Fed would probably be quit your belly aching. You're clipping a nice coupon at this point. So play into it and don't spend the time worrying about it. Again, more investors should be a little bit data dependent. How do I invest now versus how do I invest when you change the conditions? Understand what the outcomes will be and say, if you have those conversations with your advisor, those questions should be, hey, if we see the Fed do this, this may be how we respond. We might lean into this or we might lean away from that, et cetera. But yeah, I think we're range bound. And by the way, I will point out as we record this on the 21st of July, I did an interview today with Bob Dahl that I mentioned. And Bob Dahl, we had a discussion of if he had to bet on 0 cuts or 2 cuts, he would take 0.
Interesting.
So just pointing it out. And that was no prompting. I didn't know that question was going to come up. It just kind of came up right at the end of the interview. So anybody who wants to go find that show, it's right near the end of the interview. He basically said, if I had to bet on one or the other. So I immediately said, yes, Jim, I would take the other side of your bet.
Interesting. Well, I agree with you that I think that we are going to be range bound with rates. I mean, there's not a lot of demand, especially when we go out on the longer end of the yield curve. This is one reason why we shifted a few months back to be more in the shorter part of the yield curve, the belly of the yield curve, as they sometimes call it. But if we do get unemployment that does get worse, the rates will probably come down. But there's just, I guess one other follow up for you, Chuck, is just we've seen the dollar kind of crater in a short amount of time, and seems like a lot of folks outside the U.S. don't want to hold as many dollar denominated assets. It feels like the pendulum may have swung too far, and that we may see money flow back in. I'm curious to get your take on that.
I cannot remember which guest put it really well, but the fact is that what the U.S. exports better than anything else is our debt.
Yeah.
And that was forgotten when we got into all the tariff discussions and all the rest. And I'll point out that if you wanted to have the tariff situation work, the best thing you could have had to make it happen, at least if I understand economics from when I got my degree back in the day, you wanted the dollar to be weak. So all the people who were like, yes, I'm pro tariffs, go, 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 didn't understand what you had to put the dollar through. And I'm not sure we got as far as you really wanted to get if you want all of the positive tariff outcomes. I'm not sure you can go much further. That's the issue that you have. Mm-hmm. Again, you have certain things that are at odds with each other, and I'm not sure you can go much farther. But the weak dollar certainly has made a bunch of folks uncomfortable. I think the policies have made folks uncomfortable. In the end, money talks, right? In the end, we have to hope that the rest of the world is like American consumers who complain about the businesses dying out in their small town and tell you how important it is to shop local, but who are visited by Amazon trucks every day.
Every day, yeah.
Right? Because where else in the world are you going to go? right? If you know, again, multiple guests have made the point that we can talk about, is American exceptionalism, going away and all those sorts of things. No, it's not. And all you got to do is look at AI to understand it's not. That doesn't mean you shouldn't invest in international stuff, because you probably should. And that'd be a good time. The valuations are way more compelling than what I see domestically. But there are plenty of folks who can't bring themselves to do it. They're not going to be poorly served. There are very few folks in the world who are willing to say, oh, I'm going to stand on some principle and it's going to make me less money. So you got full faith and credit, even with the bond downgrade that we saw from Moody's and whatever. It's a difference, but it's not yet a substantive difference. I think they would love to find an alternative. I think there are plenty of countries that would love to find an alternative. But it's not going to be China's debt, Russia's debt, Brazil's debt. Like we can go through and go, that's what it's not going to be. I don't think it's going to be Sudan's debt either. So if it's not those places, where are you doing? And therein lies the conundrum for international investors. And thankfully, we have that conundrum, because if we didn't, then maybe the problems you referenced would be a little more advanced.
So we're at the top of the hour, Jimmy. Why don't you take us home with a final question here?
I have a very important question that I think all financial advisors want to know, Chuck, and that is that a Moneylife tequila that you're selling behind you there, or is that looks more like bourbon? What is that thing?
No, it is not. It is not. I am a journalist, and if you could see everything in my office, like this thing over here is a photo. It's been artfully treated by a friend of mine named Keith Conforti, who it's a bookshelf in an abandoned Boston public library that's actually on an island. It's been closed for years, and he gets in every 2 or 3 years, and the books are melted. And of course, I'm the author of a couple of books, and so I have that media. On the other wall, the one that you can't see, my best friend gave up his medical practice and has decided to retire and go pursue his creative passions. He also is a photographer. He was walking through a junkyard one day and found a typewriter with vines and things growing through it. So wow. I get asked all the time about the alcohol that is in the picture. I get asked occasionally by people going, are you sure you want it there? Because they're afraid I have a drinking problem. This, my friends, this is a bottle of writer's tears. And it is a writer's tears, by the way, is absolutely legitimate and very expensive Irish whiskey. But I'm a writer, I'm a journalist, and I am living in a world that, oh, by the way, it makes me want to cry all the time. And periodically, that's how I do it. So I do have a shot glass. I will happily, if you want me to, if you guys have alcohol present, I'm happy to toast.
Drink them if you got them, folks.
So
very appropriate. I don't have anything handy here. I could go down the hallway here.
I have a water bottle. I don't drink, so I can drink water.
Well, I've been drinking. People see me. This is water.
There you go.
The bottle is mostly full.
This is water, not brown water, real water.
But that is it's a bottle of writer's tears. And
I do have a question that we can end with, which I think is relevant for us as advisors to know. Based on all the guests you have on, your own personal views on this subject, Bitcoin, crypto, do you think it's going to become more and more popular in terms of wallet share for investors, and especially for younger investors, to where advisors need to make sure that we're really paying attention to it and making sure that for the right investors, there's an allocation there?
Well, okay. So we started talking about lacrosse, and I am a referee in lacrosse. I've been a referee for a long time. And when I do games, my coin for the coin toss is a Bitcoin. It's what you see as the emblem of a Bitcoin. And as I bring it out and I ask the kids and the coaches, do you know what this is? And eventually somebody always gets that it's Bitcoin. And I say, yes. But this is a 100% genuine, real, fake Bitcoin. It is completely, genuinely, really fake. Because if it had real value, I wouldn't have it on the sidelines of the lacrosse. Somebody could take it from me. This is fake. And at some point today, the currency on the field is my whistle and my partner's whistle. And at some point, we're going to blow our whistle, and you will go, that cannot be real. He's got to be kidding me. That's fake. And the answer is, It's as real as we believe it is because we set the value of the currency.
Right.
You have a choice. You can play the currency or you can not play the currency, or you can argue about playing the currency. But the game's going to keep going whether you're in it or not. So that's the analogy I use when I'm on the lacrosse field. Let me also point out, I am one of the very few people who has ever actually spent Bitcoin on something. The story goes that I wrote the Stupid Investment of the Week column for Market Watch for about 10 years, 11 years, whatever it was. And there was a time when Bitcoin went from $4 to about $32 in a week. And nobody knew what Bitcoin was. And I wrote a piece that made Bitcoin the Stupid Investment of the Week. I still have some hodler, some hold on for dear lifer who writes something about Bitcoin and pings me on Twitter every month showing it. Look at how much it would be worth if you had held it. Okay, fine. But it was the Stupid Investment of the Week, and it went from 32 to 3, so it completed the round trip in my week. I'll also point out you would have had to hold it through Mt. Gox, so you probably wouldn't still have it no matter what you were doing. And for those who don't know the Mt. Gox story, well, I've told my involvement in Mt. Gox multiple times. It's out there in various places, but read up about Mt. Gox, which was the first significant Bitcoin exchange, except that's not really what it was. It was set up to be an exchange of Magic the Gathering cards, which maybe should tell you how people seriously people were taking Bitcoin. So what happened after that was that they put a Bitcoin ATM in South Station in Boston. And I couldn't write. My boss said, you just made Bitcoin Stupid Investment of the Week. You cannot do this. I said, well, we got to go spend some. And he goes, where are you going to do it? And there was a restaurant. It has changed its name out of respect to the man, but it still exists. It does not still take Bitcoin. There's a restaurant in Cambridge called Thelonious Monkfish. They said they were taking Bitcoin. So my boss said, take the crew. They can write it up. Go get lunch. So I go into Boston. The crew meets me at South Station. We take the T into Cambridge. We took $100 in Bitcoin. So we had whatever our little receipt was that would have told us how we could do this and spend this and whatever. We get there. We spent $100 on lunch. And in the time it took us to buy the Bitcoin, take the train, eat the lunch, and pay the bill, the $100 of Bitcoin that we had was worth $67. Now, if you want to see trouble, try to explain to an accountant how you took $100, you paid $100, and then you had to get reimbursed $33 because you were down, your currency was down 1/3 of its value in 2 hours. Okay? You just kind of eat that and bury it in some other future expense report is what you do, just for the record. That's what that was my boss's idea, by the way. I'm just pointing out that's how he told me to do it. So, do you need to have Bitcoin? I don't think there's any asset you must have. There is no one right way. That's what we've been talking about this whole time. If you want it or you think you need to have it, get it. I can't argue anymore against having some Bitcoin exposure. I can argue against having too much exposure. But if it makes you feel better, if you feel like you're participating, if you want it as part of your asset allocation, I don't know why I'm telling you, why am I arguing with the whistle? It's your perspective on that one that matters. So there you go. Long-winded answer to say, again, but watch the people who are selling things, right? Because there are a few people who have found the Bitcoin religion who didn't have it all that long ago. And then they sign partnerships with people who, sell Bitcoin funds or what have you. Funny how you find religion after you find the deal.
Jimmy, great question. And Chuck, very strong answer. Thank you so much. That was a great finish. And I want to thank you for coming on the podcast. And we'll see you soon again on the Moneylife Show.
Hers and his, three's company too. Come and dance on our floor.